Hello everyone, and welcome back to this new weekly episode. This is episode 13, and it's specifically about time. We will discuss what time is, its importance in our analysis and execution, and how we can use time to be more accurate and precise in our assessments. Moreover, we'll explore how to use time to filter out lower probability conditions. We will also talk about the different concepts that can be used to time the markets and build much cleaner narratives. So far, you've probably heard people talk about how important time is, how it's more important than price, and how you should use it in your analysis. But often, they do not explain how to actually do it or what it really means to incorporate time into your analysis. In this video, I will clear up almost all of your confusions and doubts about time, and by the end, you will be fully equipped with enough knowledge to use time effectively and logically in your analysis with a solid framework to guide you. That's my objective for this episode, so let's begin. First of all, let's introduce what time is and what it actually means. We all know that ICT or CRT relies on two major components: time and price. These are the key elements that make up the charts. Regarding price, we understand that the price operates by moving liquidity. First, the market accumulates or generates liquidity, then it manipulates or targets that liquidity, and finally, it distributes that liquidity through expansions. This is how price moves on the charts. All ICT and CRT concepts revolve around the relationship between time and price. We aim to accurately combine time and price within a logical framework. This leads to a high level of accuracy. If time and price are not aligned, you won't be able to accurately catch expansions or reversals in the market. However, when they are properly aligned, you'll have a much better sense of where the market or price is heading, allowing you to position yourself accordingly. To achieve high accuracy and precision in both your analysis and execution, you must be fully equipped and well versed in both time and price. Additionally, you need to know how to logically integrate them. In ICT and CRT analysis, we often consider time to be more important than price, and soon you'll see why. Now let's talk about time and price theory. Up until now, we've discussed various concepts, many related to price and others related to time. In this part, I'll show you which concepts are predominantly time-based and which ones are price-based. Then we'll discuss how to use each within its respective aspect. On the left, you can see the price chart of the charts, and below are the concepts that are predominantly based on price and help analyze this aspect of the chart. The first one is market profiles. We've talked about this many times in our trading breakdowns, and we've even dedicated a video to it. We know that the market moves in profiles, transitioning from one profile to another over time, using liquidity to position itself. Examples of market profiles include the ranging profile, the manipulation profile, the expansion, retracement, and reversal profiles. We've already discussed different combinations of these profiles, and I will do a further in-depth video to cover them all. If you haven't watched the chapter on this, make sure to do so, as it will clear up most of your confusion about how the market moves through profiles. The second concept, predominantly based on price, is key levels. I've also made a separate chapter on this. Every key level has specific qualities and characteristics that make it significant, and each has its own implications of price action, acting as a catalyst for explosive moves in the market. Key levels are often the main driver behind expansions or reversals. In last week's video, we did discuss how to combine key levels with market profiles So if you haven't watched that chapter, I will clarify the integration of key levels with market profiles. Next, we have dealing ranges, or the PD array matrix. This divides an expansion swing or range into two halves, the discount and premium regions, each with its respective key levels, which have distinct characteristics. We've also covered the integration of dealing ranges with other concepts in a separate video. After that, we have ICT, which is the main concept used to determine draw on liquidity and build a narrative. Although it is a price concept, it doesn't work in isolation. It must be integrated with time and other price concepts to work accurately and improve your analysis. Next are concepts like turtle soup, SMT divergences, the power of three, and the market maker models. These are all predominantly price-based concepts. However, this doesn't mean you can use them alone. They must be integrated with each other within a logical framework, as they are all interdependent. Now, let's turn to time. Time is an integral part of all of these concepts, and to use them effectively, you must incorporate time-based elements. Only then will you experience the full potential of time and price working together, which is the essence of this mini-series. The first and most important time-based concept is kill zones. These are specific times of day, each with its own characteristics. Kill zones help you profile your daily range, filter out high probability from low probability conditions, and most importantly, accurately time the markets. We will discuss kill zones in more detail in a moment, but first, let's briefly cover the other time concepts. Next we have quarterly shifts, which is another important time-based topic. I will make a separate chapter on this, explaining every intricacy of it. I'll go into detail about how you can use it to catch timely shifts, expansions, and profiles at specific times of the year. Next is seasonal tendencies. A video will be coming on it as well, and you will understand how to combine them with other concepts like market profiles, key levels, and SMT divergences to generate higher timeframe trade ideas and analysis, building strong long-term narratives. Next we have seasonal tendencies, and they work best when combined with quarterly shifts, and when these two are integrated effectively, they can significantly increase your accuracy. Next, we have the day of the week concept. While quarterly shifts and seasonal tendencies help identify expansions over yearly or monthly ranges, the day of the week concept helps us pinpoint high probability days rather than months, which we'll discuss shortly. Then there's the time of the day, which relates to kill zones and key macro times during the day. These, when matched with other concepts, can greatly improve accuracy. Another time-related concept is the open high-low close, or the open low-high close concept, which you might have seen in a previous video. I showed how this concept works and how to integrate it with others, so if you haven't seen that yet, make sure to watch that episode. Next, we have time frame selection and time frame alignment, which teach you how to align different time frames logically and how to choose the correct ones to work with these concepts effectively. I've also done 2 in-depth videos on this as well. Lastly, we have weekly profiles and daily profiles. These advanced profiles allow us to divide the weekly and daily ranges into halves, based on time, with each half having its own characteristics depending on key levels, positioning in the dealing ranges, and more. In upcoming episodes, we'll focus more on time, followed by the integration of these concepts, conducting higher timeframe analysis, intermediate timeframe analysis, and lower timeframe analysis. We'll cover entry models, different types of entries, how to integrate them with your higher time frame analysis, and how to determine your draw on liquidity, both short-term and long-term. You'll also learn how to build narratives on higher and lower timeframes, properly journal, and execute with optimal performance. With all of this ahead, we're in for an exciting journey. I'm releasing it all for free, so all you need to do is stay subscribed. While knowing these concepts are important, the key is learning how to integrate them, especially with time. We'll explore how to use them to generate trading ideas, determine draw on liquidity, build narratives, and apply entry models, all integrated with higher time frame draw on liquidity. Now let's move on and talk about the importance of time. Most of us know that the most significant expansions and major moves happen at key times of the year, key times of the week, and key times of the day. By understanding the time aspect of the charts accurately, you'll be able to differentiate between low probability conditions and high probability favorable conditions. This understanding will enable you to catch explosive and significant moves with a high degree of accuracy. With a solid grasp of time, you'll be able to build a sharper and clearer narrative. The most important aspect of time is that it confirms the validity of the price concepts we've discussed, such as SMT divergences, key levels, weekly and daily profiles, turtle soup, CRT, and others. For the validation of all these concepts, time is key. If the time is aligned correctly, we can confirm that these concepts are valid and use them to generate trading ideas. But if the time isn't aligned, we should avoid them and wouldn't consider it valid. Time serves as a major confidence booster for generating trade ideas. Lastly, time acts as a powerful filter. It's one of the best tools for filtering out low probability conditions, allowing you to only engage in high probability setups. Now, let's look at some graphics and see how it confirms the validity of certain concepts. So moving on to the next slide, in this graphic, first of all, we have a key level, and then we see two different types of reactions that the price had towards this key level. We will discuss why both reactions are different from each other and what led to the difference in reaction at the respective key levels. First, let's discuss the reaction on the right. You can see a green rectangle at the bottom right, which represents a key time depending on the time frame. For example, if we are looking at the 15-minute time frame, this green area would represent the London Open Kill Zone, the New York Open Kill Zone, or any other key time of the day. If you're looking at the 5-minute or the 1-minute time frame, this green area would represent a macro or specific time, such as the 3 a.m. macro, the 8 a.m. key time, or the 11 a.m. key time. If this was on the 4-hour time frame, the green rectangle would represent a key time of the week, such as a Tuesday or a Wednesday. The point here is that each time frame has its own respective key times, and you need to differentiate between them. Also, these reactions are fractal, meaning you can find them on all time frames, depending on time frame alignment. Don't limit your thinking to just the 15-minute or the 4-hour chart. It happens on every time frame. For example, on a monthly chart, the green area would represent a seasonal bullish tendency. So it all depends on the time frame you are looking at. Based on the time frame, you decide whether to focus on seasonal tendencies, kill zones, or other key factors. Now, back to the topic. Let's say this green area represents a key time on its respective time frame. You can see the price came down to test this key level and formed a turtle soup below this low inside a key time. That's why, after testing the key level and forming a turtle soup below this low, price expanded straight away. If you had taken an entry there, it would have worked perfectly because time and price aligned. The turtle soup, testing of the key level, and the higher time frame draw on liquidity target all aligned, which is why price expanded higher. Price tested the key level at a key time, making it high probability, and price took off immediately after. This is the first type of reaction to a key level that happens at a key time. Now, let's look at the second type of reaction. In the second example, we see a grey area. This grey area represents the opposite of a key time, a time when price typically consolidates or forms a ranging profile, not a high probability time for turtle soups or testing key levels. For example, the Asian session isn't a key time for major forex pairs like Euro versus US dollar, Great British Pound versus US dollar, or the US dollar versus the Canadian dollar, and price will typically range during this period. Let's assume we are looking at a 15-minute chart. This grey area represents the Asian session. The green area represents the London open kill zone, which is a key time of the day. During the Asian session, which isn't a key time, price came down to test the key level and formed a turtle soup in this grey area. Because this happened outside of a key time, price did not expand immediately. Instead, it ranged and eventually came down to break the low it had formed earlier, stopping you out. This happened because the timing was off. Price reacted at a non-key time, so the turtle soup and key level test weren't confirmed. If it had occurred at a key time, like the example on the right, it would have been a favourable reaction. After the Asian session ended, price came down again to take out the Asian session range low, tested the key level, and formed a turtle soup at the London open kill zone, which is a key time. This time, price expanded immediately because the timing was correct. In both of these reactions, price had a similar approach to the key level and similar turtle soup formations, but the outcomes were completely different. Without an understanding of time, you would be confused to why one reaction led to a quick expansion while the other didn't. Now you know that the key difference was the time. This is the main takeaway. Concepts work best when time is integrated, and reactions happen at key times of the year, week, or day. I hope you understood both examples of the different types of reactions. In the right side example, you would have waited for a key time, like the London open kill zone, before forming any trade ideas or taking a trade, even though price already tested the key level. That's the importance of time. Key levels in turtle soup are often useful on their own, but they are most effective when combined with the correct timing. Now let's move on to the next example. Here, we'll again discuss two types of reactions to key levels and two types of SMT divergences. By now, I hope you understand the framework, but if not, let me explain. The green area represents a key time, which could be any key time depending on the time frame that you're looking at. If it's the 15-minute time frame, this would represent a kill zone. On the 4-hour time frame, it would represent a key time or day of the week, and on the 1-minute time frame, it could represent a silver bullet or key times like the 3 a.m., 8 a.m., 9 a.m., 10 a.m., and so on. The grey area, on the other hand, represents the opposite of a key time, essentially a low probability or unfavourable time that we would want to avoid, the same as the previous slide. In the second graphic on the right, you can see that price came down and tested the key level at a key time. Additionally, we had an SMT divergence form at a key time with a correlated asset. The correlated asset might have taken out the low it formed, but this one struggled to do so, which created the SMT divergence. Since this divergence occurred at a key time, price expanded immediately and moved higher. On the other hand, price tested a key level and formed an SMT divergence with a correlated asset or pair, but both of these events happened at an unfavorable time when it wasn't a key time. That's why this trade didn't work out and moved lower, stopping you out. As you can see, testing a key level and forming an SMT divergence are both great, but they need to occur at a key time or you won't see their full effect. In both of these examples, it was time that confirmed the validity of price. So you can see that time is more important than price. I've proven it here. Everyone talks about it, but no one explains it in this way, like I am in this video. And this is just the beginning. We have so much more to discover in the deeper levels of this mini-series. I will continue discussing concepts like this, and by the end of the videos, you'll have nothing to worry about. You'll be fully equipped with enough knowledge about time and price, and how to integrate them effectively. Here's another graphic that highlights the importance of time. On the right, you can see that the CRT was purged at a key time, and after that, price went on to take out the opposing range high, making it a successful trade. However, in the graphic on the left, the CRT was not purged at a key time. That's why it only reached the 50% mark before reversing and taking out the low. While it technically worked in reaching the 50% mark, for it to be the most effective, the purge must happen at a key time. Only then will you fully see its potential when it aligns with the higher timeframes draw on liquidity. This then allows you to catch the same executions and perfect trades just like I do. This is the power of time. Price concepts on their own are valuable, but it's time that validates and confirms their effectiveness. Always keep that in mind. Now let's talk about the most important part of this chapter: how to use each of these concepts and which timeframes they are best suited for. First, we have time of the year. To find favorable times of the year and filter out lower probability conditions, you can use concepts like quarterly shifts and seasonal tendencies. These help you identify high probability key times within the yearly range. These concepts are best applied on higher timeframes, such as the monthly, the 3-month, or the weekly timeframes. Next, we have time of the month. If you're looking for higher probability key times within a month, such as key weeks, you can use concepts like the open, high, low close concept, which helps divide the monthly candle or range into quarters. You can also use AMD to profile the market, or the power of 3 to build a narrative for the monthly range. For dividing the daily range, you can use concepts like kill zones, key times, and the open, high, low close concept. These concepts will help break down the daily range into quarters and filter out lower probability conditions. I've made episodes on a few of these concepts, and there's more to come, so make sure to watch them all. Moving on, another important aspect of time is that it can be used to confirm the validity of these concepts. I mentioned this earlier, but let me explain it in more detail. As I said, time is a powerful tool for confirming concepts, ideas, narratives, or models. We know about these concepts, and they can be confirmed and validated by using the correct timing and aligning them with key times. For example, key levels are formed at key times. Since multiple key levels can exist, you might wonder which ones to select. This is where time comes into play. You only choose key levels that formed at key times. Then use your time concepts depending on the time frame that you're analysing. If you're looking at the yearly or monthly chart, you can use quarterly shifts and seasonal tendencies as your filters. If you're analysing the daily range, you can use kill zones and other key times to focus on the key levels formed within these periods. Similarly, key levels are tested at key times, just like they are formed at key times. I showed you an example earlier of how this works and why it matters. In the same way, CRT formations and purges happen at key times as well. CRTs occur across all time frames, but to filter out low probability ones and focus on the higher quality ones, you need to use time as a filter. The most important point is that the change in state of delivery, or the CSD, or order block entries are also formed at key times. CSD, which happens when the price engulfs the candle that purged the CRT or that purged the range, is crucial. After this engulfment, an order block is formed, which we refer to as a change in state of delivery. The entry generated after an order block is called a Model 1 OB entry, and the best ones are formed at key times. When looking for entries, you need to ensure they occur at key times. If you reverse engineer my trades, you'll notice that most of my entries are made at key times. This is because I wait for the price to test a key level at a key time, for the purge to occur at a key time, for SMT divergence to provide confirmation at a key time, and finally, for the CSD to happen at a key time. Once everything is perfectly aligned, that's when I take my entry. This is why my win rate is so high, because I only take trades when all conditions are in perfect alignment. Other people may call them A+ setups. If you're a smart student of mine, you'll realize that using time as a filter allows you to wean out low probability conditions and only take the most perfect setups. That's why I have between a 70 and 80% win rate and consistently enter the market at the right moments. In fact, I did post into my Telegram, I think it was out of 118 trades, I won 115 of them and only lost 3. I wait for the best possible time when everything is aligned and avoid low probability, unfavourable market conditions. Lastly, SMT, or smart money tool divergences, also happen and form at key times. On to the next slide. Right here in this graphic, you can see that we've got this high, and what happened is that price came above and took it out with the 5 a.m. candle. You can also see that we took out this high at a key time, which is 5 a.m. It's a key time during the day and also means we tested a key level at that time. After all, we know that the highs and lows are key levels too, maybe even the most important. With that, you can see that this candle can now be treated as a CRT because it tested a key level and also formed at 5 a.m, which is another key time. Then it was purged at another key time, which is 9 a.m. All of this led to price expanding lower to take out the opposing range low of the CRT. This is exactly how you capture a high probability CRT at key times, and that's how you build a sharp narrative around it. We've got another example here. You can see we formed this low first, and then price came down below to purge that low with this particular candle. Now when this candle gets engulfed, it results in a CSD, or a change in state of delivery, and because of this, an order block entry would be formed there. Once price engulfs that candle, it is a CSD. A lot of people ask me, and that is your answer. You can see that the price came down, hit the order block, and then expanded higher. The most important part of this CSD is that it occurred at a key time, which in this case is Tuesday. You can see that Monday formed a range, and then that range was purged on Tuesday, which is a key time for purges, and price formed the low of the week there. So we had a weekly profile low and a CSD on Tuesday, a key day of the week. After that, price expanded higher for the rest of the week. That's why this CSD worked out perfectly, because it happened at a key time. If it happened at a different time, it wouldn't have worked out, even if we had the same price action, because we know that time is more important than price. Moving on to the next slide, here we'll discuss key times for different time ranges, like the yearly, monthly, weekly, and daily ranges. At the end, we will also cover the kill zone for your daily range and some key terms to note down. The first topic is the yearly range and how to use time within it. As I mentioned earlier, for the yearly range, you'll use concepts like seasonal tendencies and quarterly shifts. Significant moves and expansions throughout the year can be identified by analysing these seasonal tendencies, aligning them with quarterly shifts, and checking for major SMT divergences. I will be creating a video next week on this process, so you should watch that for a better understanding. With this approach, you'll be able to identify the best month within the yearly range for expansions and significant moves. Next up, we have the monthly range, and we'll learn how to use time to filter it. For this, you can apply concepts like the open high-low close concept, AMD, and the power of 3. Keep in mind that these aren't the only concepts that you will use. You need to combine various price and time concepts in a logical manner. You'll use key levels, CRT, dealing ranges, and more. Make sure to match these with higher time frame analysis from the monthly and yearly charts. The OHLC concept helps divide the monthly candle into quarters, revealing the best times of the month around key levels for expansions and significant moves. This approach also acts as a filter to avoid markets during ranging conditions. The basic idea is that week 1 typically represents consolidation or a ranging profile. Week 2 involves manipulation to grab liquidity, and week 3 is when the best distribution moves happen. Week 4 can either be a continuation of the trend or a reversal, depending on whether key levels have been reached, and draw on liquidity. This is just a foundational idea to help build a narrative, but you'll be able to create various scenarios and generate trading ideas with this approach. Moving on, in this slide, we're going to discuss how to use time within weekly ranges. We'll use concepts like the OHLC, AMD, and weekly profiles. Weekly profiles are the most important for building a narrative, as they take time into consideration for generating ideas. The weekly framework follows the same principles as the monthly framework. You just need to integrate it properly with higher time frame analysis and use concepts logically together. By doing so, you'll be able to identify key times within the weekly range for significant market moves. Now, in this final slide, we'll discuss the kill zones for both Forex and indices, along with the characteristics of each kill zone and some key times. For Forex, the kill zone times are as follows. The Asian session runs from 8 p.m. to midnight Eastern Standard Time, and we know that it usually forms a ranging profile and isn't considered a key time. If you're trading major forex pairs, as I said earlier, like the GBP, the Euro, or the Canadian dollar, it's best to avoid trading during this time. Next, we have the London Open Kill Zone, which runs from 2 a.m. to 5 a.m. Eastern Standard Time. This is a key time for manipulation profiles or expansions to form. The London Open is typically when the high or low of the day is set, so you can look for price testing key levels. CRT setups and turtle soup setups often occur during this time, and time will confirm their validity and quality. The London Lunch, which runs from 5 a.m. to 7 a.m. Eastern Time, can also be a reversal profile, especially if London Open reaches the draw on liquidity. In this case, the 6 a.m. candle may purge the 1 a.m. 4-hour CRT and reverse from there, or it may continue the London expansion. Next is the New York Open, from 7 a.m. to 10 a.m. Eastern. This is another key time for expansions, testing key levels, and purging liquidity or turtle soup setups. However, it's crucial to ensure all elements align before making decisions. This makes your choice informed and not random. The New York Open is also a good time for CRT purges at the 9 a.m. candle and potential price reversals if the liquidity has already been hit, or it could continue the London move. During the New York Open, the optimal trade entry, or OTE, forms with price retracing slightly before expanding. The London Close Kill Zone, which caps the daily range, is a perfect time for CRT purges and price reversals. Each kill zone has different characteristics, but the outcomes, whether continuation, reversal, or retracement, depend on the framework you're working with. Ensure you are using the right framework, higher time frame analysis, and draw on liquidity. Your narrative needs to be sharp and accurate. On the left, you can see key times within the kill zones where you can look for purges, turtle soup setups, SMT divergences, or key level tests. If you reverse engineer my strategies, you'll notice that most of my entries are taken within the key times and kill zones. At the bottom, you'll see the kill zones for indices. The key time characteristics remain the same, with the addition of the New York AM and PM kill zones for indices. All these times must be mapped with price movements to make informed decisions. Everything needs to be accurately integrated with the rest of the concepts, and that's how you'll see how effective it can be. This episode alone is enough to equip you with the right knowledge. I hope you enjoyed. If you did, if you could leave a like, subscribe, and turn on those notifications so you don't miss out. I do upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently in the middle of a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. That concludes the time chapter. See you in the next one. Happy trading.